Steve, doing a postmortem on the 2016 closed-end fund market, it was a pretty good year. From a price return standpoint, all closed-end funds returned about 8.5%. Most of the sub-asset classes also had positive returns, anywhere from munis up 50 basis points to taxable fixed up over 16%, I believe. And then from a discount standpoint, all closed-end funds had discounts narrow about 150 basis points on average, coming into the year at 8 and ending the year about 6.5. So any way you look at it, pretty good year for closed-end funds, even in light of capital market returns broadly. So Steve, turning to 2017, give us your thoughts on what we may see in the closed-end fund market.
Sure. I think 2016 was such a win-win from both a NAV and discount narrowing perspective that it would be hard to imagine replicating those kind of returns. Frankly, I would be very surprised if you saw taxable bond funds, up near 20% returns again, simply because spreads have narrowed so much as it is that you don't have that much juice left to squeeze. But when I think about 2017 returns, you really have to break it down in two ways, and you've got NAVs and discounts. Now it's true that discounts tend to follow NAVs, and so making any sort of forecast, we kind of need to better frame the question. And I would say if bonds clip their coupons and equities, deliver a earnings growth plus distributions type of return, then you have an environment where I think discounts continue to narrow. You said they narrowed about 150 basis points last year. I think you could see another 150 basis points quite easily because investors buy assets when they're doing well. The typical investor is going to look at their closed-end fund portfolio and they're going to say, wow, the average fund was up 8.5 and I've got a couple in my portfolio that were up 20 and the average distribution yield is still 7. If those funds are also trading at a 7 to 10% discount, I wouldn't be surprised to see those trading at 5 because investors tend to put more capital to work when things are going well. And I think bank loans are a perfect example of this, where last year when we had this conversation for December, bank loan closed-end funds were trading at 10 to 12% discounts.
Right.
And now your average fund's trading close to par. And the reason for that is returns were solid. Investors put money into open-end mutual funds and ETFs, and some of that trickled into closed-end funds, and discounts narrowed. And so that was really just a case of demand pushing discounts narrow, and that demand was based off investors extrapolating returns in the future. And I think that's fair to assume for closed-end funds as well. If you assume an environment where bonds are clipping coupons, then investors will continue to put capital to work in closed-end funds because they are cheap and discounts have a lot of momentum. On the equity side, discounts are still really cheap. You've got closed-end funds that own, U.S. large cap stocks trading at 10 to 15% discounts. And we've covered the reasons why that's the case, higher fees and active management. But in an environment where taxable bond fund discounts are narrowing, which is, my assumption, the rising tide will lift those as well.
Right.
And so your 15% discounts could easily be, 10 to 12. And I think that's, it also coincides if positive sentiment towards equities persists, it's just really hard to imagine discounts trading at the same level that they have been for the last few years. And so that's kind of my forecast for discounts. I think discounts continue to narrow. But again, on the NAV side, valuations are high across the board. Equity valuations are high. We need earnings growth to deliver to really justify those high multiples. And on the fixed income side, most taxable closed-end funds have corporate credit exposure. And so a lot of that exposure is high yield bonds, which is the reason why we talk about it so often. And you've got spreads that are 50 basis points above their post-crisis lows. And so it's just mathematically impossible to deliver another 17.5% return. And so when I think about the NAVs, it's a tough question to answer because technically I think discounts continue to narrow, but fundamentally investors should be thinking about taking some chips off the table because asset class returns have been so strong. And so that goes to, I think it'll be another good year for closed-end funds, but it's not going to be anything like 2016.
So to that last point, Steve, I guess it's important to note that while you have an attractive structure in a closed-end fund from a valuation standpoint, the assets inside of that structure are obviously more fair value than they were at the beginning of 2016 when you saw some capital markets dislocation.
Exactly. I mean, if we're talking about lower beta, lower asset class returns, then it makes more sense than ever to own that asset class through a closed-end fund because the ability to generate a couple hundred basis points of alpha is a large part of that expected total return.
Right.
Whereas last year, just going back to high yield bonds, if the NAV was up 20 with a little bit of leverage and the market price was up 22, nobody really cared that much about that 2% of alpha. But I think a high yield bond fund with a 6-7% expected return, you add 200 basis points of alpha to that, and it looks a lot juicier. And so when I think about asset classes and exposure levels, I think it's fair to say that investors should own, it's obvious from a valuation perspective, own less risky assets when valuations are high. But when you own those asset classes, if you have an allocation to equities or spread fixed income, it makes a lot of sense again to own those at 7 to 10% discounts.
Steve, you brought up a couple of interesting points that I want to circle back on. First being distributions. We have talked at length on some of these videos about the fact that the closed-end fund market is generally ultimately owned by retail investors. And one of the reasons that retail investors are attracted to closed-end funds is yield. I personally find it interesting that the list of funds that cut their distributions in 2016 is pretty lengthy, yet the closed-end fund market, as we referenced earlier in the video, had a great year. So can you help me sort of marry cutting distributions with the fact that discount narrowing and positive total returns was a theme for last year?
Sure. I think, more often than not, your average closed-end fund cut their distribution. And a big part of that is just spreads coming down. And so the asset side is earning less. And on the liability side, the cost of short-term borrowing has increased. And so distributions have been cut. Despite that, discounts narrowed on average. And asset class returns were positive, but that's not necessarily correlated to the movement from the discount. And so when I think about distributions, it's important to remember that most closed-end fund sponsors kind of tweak distributions every month. And so if every month, every other month, the distribution gets lowered 1.5%, that doesn't really bother a lot of investors because the distribution from an absolute standpoint is still pretty high.
Right.
The issue is when you've got sponsors that cut once a year and it comes out of the blue, or at least to the blue to investors that aren't doing their homework. And that's the homework just being reviewing the distribution power of each closed-end fund. That will always, if you've got a closed-end fund that has a unsustainably high distribution rate and they cut it and they're already trading at a relatively rich premium or discount, then you always have that classic sell-off, which most people expect when a closed-end fund cuts their distribution. But for the most part, bond funds stick pretty close to paying out what they earn.
Right.
And the rise in LIBOR and the decline in yields on the asset side, it's been gradual and the distribution rates have been gradual as well. And so people don't have the same knee-jerk reaction as they might have in the past. And to be fair, a big part of that is that closed-end funds are still pretty cheap. And so if your closed-end fund is trading at a 10% discount, it cuts the yield 2%, 2% distribution cut on a monthly basis, maybe it's only 25, 50 basis points annually. Nobody really cares about that.
Gotcha. Question number 2. Let's talk about activism for a second. In a couple of videos last year, we talked about sort of the rise in activism with some of the discount levels being somewhat wide. And in addition, some new players from an activism standpoint. Is that something you think will continue in 2017? People from the outside trying to force discounts narrower in certain funds? Or have we kind of come through that cycle now with discounts narrowing a little bit?
I'd say that now is probably the riskiest time to be a closed-end fund trading at a double-digit discount. There's more investors, in my view, with deeper pockets than ever trying to push closed-end funds to narrow the discount. That said, there's not a lot of funds trading wider than a 10% discount. And so I think the number of funds that are going to receive pressure will decline. But any fund that's trading wider than 10%, I think is highly susceptible to shareholder activism. And that, frankly, is good for the space because closed-end fund discounts should never really get wider than 10%. When you're trading at 85 cents on the dollar, that's a failure of the fund company, it's a failure of the board, and it frankly tells you the market doesn't want this investment vehicle.
Right.
And so I think it's really important that there's that balance in the market, and institutional ownership has, in my view, kept discounts narrower than they otherwise would be. But again, to your point, do I think activism will continue? I think it's been successful enough that it will always be there from an opportunistic standpoint. But if our base case plays out and we say that discounts continue to narrow, then I suspect that there will be a number of liquidity events for 2017 because a lot of investors have already deployed the capital and they need to find an exit of their investment. And so some of those will play out in 2017, but the number of new campaigns should certainly decline because the math isn't as attractive if you're starting at a 7 or 8% discount.
Steve, on that last note, if you think broadly about activism in 2016, without mentioning specific names or campaigns, was activism successful as a strategy in what was already a pretty good market for closed-end funds last year?
Sure. Closed-end funds across the board narrowed, and funds that had shareholder activism, whether a liquidity event was provided or not, the presence of new demand from institutional investors or copycat investors narrowed those discounts as well. And so I think everybody won in 2016. 2017, it's always tough to say, but from an institutional standpoint, I think there's a lot of opportunity still in a number of closed-end funds that are likely to have liquidity events. But again, that number of funds under attack should decline in 2017.
Last question, Steve. We talk frequently about, again, the fact that the closed-end fund market is generally a retail-owned market. When you look at the wide discounts early in last year and then the subsequent performance of closed-end funds for the balance of the year, has that attracted any type of new player into the closed-end fund market, whether it be institutional or otherwise, or are we still sort of at that 90% retail-owned market that we have talked about at RiverNorth for a number of years?
It's still a retail market. When closed-end funds IPO, they're predominantly owned by retail investors, and so it certainly would take time for the investor mix to change. What I think is really surprising, and it's a consequence of discounts being wide for so long, is that many investors and many fund sponsors didn't think it was possible for institutional investors to accumulate 10-15% of a fund in a very short period of time. And it's happening. And it's happening on dozens of closed-end funds. And the reason for that is that from a market price standpoint, a lot of closed-end funds are, when you think about distributions and then the discount widening that occurred since 2013, you got a lot of funds whose market price are well below where they were trading in 2012, 2013.
Sure.
Total returns are still very strong, but from a market price perspective, the market prices are lower. And from a discount perspective, there's a lot of investors that are selling out of closed-end funds at 10% discounts. And they're able to accumulate very large size without moving the discount the way you might have thought so in the past. And I think that's a symptom of two bear markets in closed-end funds. You had the taper tantrum, and then you had another bear market in 2015. And so when investors lose that kind of money twice, despite everybody else making so much money in other asset classes and other investment vehicles, that just sows the seeds for unhappiness and discontent, and that a lot of investors sell closed-end funds or look to get out, and these institutional investors are really coming out of nowhere to pick up that liquidity. And so what historically kept the market retailed, primarily retail, was the lack of trading liquidity. It was really hard to accumulate a 10% position. But now a lot of investors are like, look, I want to get out of these closed-end funds, and so I'm happy to sell to this strong buyer. And so sorry to interrupt, the strong buyer providing liquidity for the others to exit the trade. Exactly. And so there's it's kind of the pig and the python. There's a lot of shareholders that want out of closed-end funds, and the liquidity provider recently has been, institutional investors that are pressuring for change. Again, I think with returns being so strong and a lot of the selling already taking place, that volume of selling should subside, and that's a big reason why discounts narrow, right? Because discounts are only narrowing when there's an imbalance to the buy side. Right. And so if all of a sudden all the sellers from a retail perspective just say, hey, look, I don't really dislike this closed-end fund anymore. Right? Look, it was a great return in 2016. Maybe I want to own it. Maybe I want to buy it. Then all of a sudden discounts narrow, and in the market where discounts are 7% to 0, that's going to be a retail market. Gotcha. An environment where discounts are 7 to 12, that'll be an institutional market. And so the last 3 years has really been an anomaly, and it has actually increased the institutional ownership in the space. But I think that is cyclical, and as discounts narrow, it will go back to more of a retail market. Steve, thanks as always for your comments, and I look forward to seeing how the year unfolds. Thanks, Alan.